Guys, these are 5 AI, artificial intelligence stocks to watch. Now, this is different than our past video. Our past video, we did some high-flying AI stocks, and the comments below were like, well, of course these are the AI stocks. What about the ones that aren't being promoted as much as AI stocks? We decided to do this video. 5 AI companies that aren't as promoted. They're still well-known, but not as promoted. Stock number 1, Arista Networks. ANET is the ticker symbol. So we're going to pull it up right here and go through it. Guys, look at this thing. Just on a path to the moon, right? Look at this. 52-week high, 307.74. It's currently at 265, so it's down quite a bit from its all-time high. That was in March 22nd, just 2.5 weeks ago? Just 2.5 weeks ago, it was 307. Now it's at 264. What's that drop? 12, 13%? That's pretty incredible. Look at this. High return on invested capital, high return on assets, and high return on equity. Great stuff to see here. This means they do a great job of investing the money and getting a return on the money that's invested in the business. Free cash flow last year, $1 billion. Look at this, guys. Their 5-year average free cash flow. Sorry, last year was $2 billion. 5-year average is $1 billion. They did double their average the last 5 years last year. Net income, pretty close to the free cash flow. Love it there. Now, price to sales ratio looks a little rich. This is where you sit there and go, okay, how do I compare companies that have in the networking and the software business and the tech world? Well, price to sales is one way to look at it. They have a good gross margin, 62%. Means every sale they get, 62% can go to the bottom line after paying for overhead. Great profit margin. This sounds a lot like Microsoft, guys. Microsoft has a higher gross margin, but their profit margin's about here. But look at this, guys. Price to free cash flow of 42, PE of 40. It's a little rich, but again, could be okay because they have a high return on invested capital. Now, of course, I'm going to sit here and say it's going to be kind of hard to justify 40 times earnings, but when the stock keeps flying, the stock keeps flying, and here are the analysts, and look at their earnings per share estimates for the next few years. 743, 839, 910, 993. Good double-digit growth right there with revenue growth of mid to high, some double-digit areas over here. So this is a company with a lot of future potential. Is it an AI player? That is what we've seen. A lot of people thinking this is an AI play, which very well could be. I think pretty much everything is an AI play today. And here are the 8 pillars, guys. So slight increase in shares outstanding, not a big deal, but the big number here is 5-year PE and 5-year price to free cash flow. Obviously exaggerated because their free cash flow net income has skyrocketed in the last 5 years. Stock number 2, Palo Alto Networks, down 2.5% today, all-time high, reached on February 9th of this year of 380.84. It's currently at 272. Boy, that's a 26, 27% drop. Look at this. 52-week low of 176. So it went from 176 to 380 to 260 or whatever it's at right now, 262, 272. That's pretty incredible how that works. Again, a high 5-year return on invested capital. Look at this low return on invested capital last year. I wonder why that is. Something must have happened there on their books. But look at their free cash flow. Last year, 2.92. 5-year average of 1.85, much higher than their net income and their 5-year average net income. So I like that a lot. Big stuff. But again, a high price of free cash flow, high earnings, 74% gross margin. That's insane. That's crazy. That's an awesome gross margin. That's NVIDIA type gross margins right now. Their 5-year average profit margin was 5%. 1 year is at 30%. So something's happened in the last 5 years that affected that greatly. Let's see what else. Because look at this. The 5-year free cash flow of 1.85 is very different than their 1-year net income of 261 million. It shows there's probably some write-off that happened in this time that accounted for that. So Palo Alto Networks, let's go check out the 8 pillars here real quick. Just like Arista Networks, is at the much higher 13% of shares outstanding increase. Okay, not the worst, but guys, pump the brakes here. I don't blame them because look at this price PE ratio, 5 years, 372. But remember, because of this big drop in net income. Okay, so I'm going to show you guys that right now. Let's go to the income statement to show you guys that big negative. Let's see where it is. So here it is, provision for income taxes, minus 1.4 billion right there. Now, guys, here's where I sit there and say exhibit caution. This is why I love doing this. Look at the income statement here. Here's our profit over the last 10 years. Negative 150, negative 200, negative 174, negative 74, negative 174, negative 368, negative 460. Finally a profit, and then 2.3 billion in profit. But a big part of it was a big credit for provision of income taxes. That was a big number there. So factor that in when looking at Palo Alto Networks going forward, okay? Let's see what analysts think about this company. Let's go to analyst estimates. Oh, big time growth in EPS. Look at this, guys. 562 this year to 1270 in 2028. Big jump right there. And revenue growth, huge. 8.35 billion to 16 billion. Another big jump, multiple double digits. Guys, all the more reason to look at this. Take a look at this company if you want to get a little bit more exposure. Stock number 3, ServiceNow. These guys provide automation for SaaS, which is software as a service kind of companies. For example, our software here is software as a service, but this company has a lot of AI potential. And if you look right here, back in October of 2021, it hit a high of $698. It fell and then rebounded, and its recent all-time high, February 9th of 2024, $815 per share. Where is it currently? It is currently at $740. So it's pulled back about 10%. Of course, I think the AI boom might be failing people now, or at least slowing down. Again, just like 2.7 billion in free cash flow last year versus 1.7 billion in income, 1.8 billion in free cash flow the last 5 years versus 606. Much higher free cash flow consistently over the last 5 years. Again, a really high PE and price to free cash flow, 56 on the price to free cash flow, 88 on the PE, big time numbers, 78% gross profit margin. Guys, such a high gross profit margin, I'm kind of surprised by 10% 5-year profit margin and 19% last year. I would have thought it'd been higher, but there could be other reasons why it's happening. Let's go see their income statement. Are they growing a ton? Is that what's going on here? I mean, look at this revenue growth, guys. 1.4, 1.9, 2.6, 3.4, 4.5, 5.9, 7.2, $9 billion. So if you guys like this company, I love that growth. Make sure the growth is sustainable. Let's look at their operating income. They were losing money along the way. Look at this operating income, negative 166, negative 112, negative 64, negative 42, 42, 200, 257, 355, 762, increasing operating income. This shows the fundamentals of the business were getting better and better. So that is great. ServiceNow might be a good play. Let's go check out the analyst estimates here. Holy cow, doubling their EPS from 1283 this year to 2596 in the next 4 years. Big time growth. Revenue growth, according to analysts, 20% growth a year. Guys, without doing more due diligence on the company itself and the qualitative aspects, what makes the company good? What's the story? This thing intrigues me to go, okay, I should probably take a look at this company from a numbers perspective, right? So let me go to our stock analyzer tool. Remember, when you buy a stock, you're buying a piece of a business. And if you pay a reasonable price for the company and the revenue and profit go up by 10x, what do you expect the stock to do? It'll probably go up around there, right? That makes perfect sense. You have a neighbor, they have a mechanic shop. They sell it to you for $500,000 because it makes $100,000 a year, 5 times profit. If you're able to grow that business to $1 million in profit in 10 years, what's it likely worth? It's likely worth $5 million, right? Of course it is. It's no different for stocks. The only difference is with stocks, we see Mr. Market every single day telling us what they think the stock is worth, up, down. He's happy, excited here. He's sad here. He's happy and excited here. This is just the market. This is just the people out there reacting to the news. And news follows the stock price. I'm sure at this point, the news was bad in ServiceNow. At this point, it was amazing. I'm sure now it's better than normal. AI is an exciting story. You might have FOMO. You might be like, I don't want to miss out on the AI boom. That's why we're making this video. But I want to reiterate, you've got to exhibit caution. Just like we exhibited caution 3 years ago when everybody told us how stupid we were about EVs, cannabis, all these other companies that all went down 80, 90%. Have I been wrong on companies? Absolutely. But usually the companies I'm wrong on are errors of omission, which means I didn't buy a company that soared. But the companies that I avoid for the right reason. If you overpay for a good thing, it can make it a bad investment. And we've all been there. We bought an exciting story and then the stock falls. And then we go, well, the story, is it there anymore? I don't know. Well, when the stock's going up, the story's great. When the stock's going down, it's not. But what I'm trying to teach on this channel is fundamentals. How do you buy a company based on the right fundamentals? Paying a good price for the company. Then you make the money by sticking with the company and managing your emotions. Every great investor tells you you're going to make a ton of money by holding on to something and watching it run, not worrying about here or there, what's going on in the world, etc. We just had Iran attack Israel this weekend. Bitcoin plummeted. Everybody thought the markets were going to open low today. They opened up high and now they're low. We don't know what's going to happen day to day. But if you buy great companies at good prices and you're able to hold them during thick and thin, during good and bad, because you realize that over long periods of time, there's going to be a lot of bad in the economy, there's going to be a lot of good. But if you're able to figure out a way to avoid that lonely road and be around like-minded individuals who are going to help you stick onto the companies that you make a lot of money as it compounds, you're going to do very well in investing. And the key to that is limiting your emotional decisions. I realized this about myself a while ago. I realized how I was making an emotional decision that was costing me money. Then when I finally realized that fundamentals drove stock prices, it's like the world opened up to me. And life became easier and I was a lot calmer. The thousands of people in this community all think the same way. They love red days in the market. Those are good days for us. We want to see the companies we love at discounts. We want to avoid hype. We sit there and say, is this hype? Is it not hype? And that's why I created the community. I wanted that place where everybody could go and think and act together in a certain way. Now, they don't agree with each other all the time. That's not the point. The point is to bounce ideas off each other. So if you want to make less emotional decisions, click the link below, $7 for 7 days. Go sign up. Guys, if you're watching this video, it's because you have an eagerness to learn. Might as well learn with people, with thousands of other like-minded investors. Click the link below. It'll be a great thing for you. Adobe, guys, I consider Adobe to be one of the best software companies out there, almost as good as Microsoft. It's an incredible company. It's down about 1% today, all-time high. November 22nd, 2021. It's one of the few companies out there that's an incredible company and doesn't have a recent all-time high, $700 per share. Last year, less than a year ago, it was at $331. It had fallen that much. And now, look at the price, $469. So maybe Adobe is a good value right now. Now, again, price versus value, totally different things. But here are the great things about Adobe. By the way, if you're one of those people who had Adobe here, remember, this is all gone. Don't worry about where you bought it. Worry about where it's going. Worry about where the fundamentals of the business justify the price. And we'll get into that with our stock analyzer tool shortly. But look at this company, $214 billion market cap, buying all the shares in the market. It would cost you $214 billion to buy them. Enterprise value. This is buying the entire company with all the debt, all the cash, et cetera. It would cost you $220 billion. That's only $6 billion of net debt. And guess what? Last year's free cash flow, $6.5 billion. 5-year average, $6.15 billion. This company spits off cash, higher than its net income. 88% gross margin. Guys, can we just stop for a second and realize how amazing this company is? They dominate the world of those graphics, Adobe Photoshop, Reader, etc. They have 88% gross margin, and they're selling their business. Before in the past, you had to buy an Adobe CD, put it in your computer, put it in, and wait 2 or 3 years before you upgrade it again. Now you just pay the software every month, and guess what? You get all the upgrades. It's wonderful. I love the fact that companies do this now. Microsoft does it. All these great companies do it now. We do it. Our service is the same way. You don't have to buy one program and wait for the upgrades. You get it constantly. That's what's so great. Now, let's go check out the 8 pillars real quick. 8 pillars look at this. Valuation driven. 5-year PE is 46. 5-year price of free cash flow is 35. I love the fact that the price of free cash flow is lower than the PE ratio over the last 5 years. It shows they're making more free cash flow than earned net income. Another thing I love, net income grew at $1.57 billion over the last 5 years, but cash flow grew at $2.18 billion. This company is spitting out cash. And I love the fact they don't pay a dividend. Keep that money in there and wait for the stock to fall and start buying back more shares. I'm not a big fan of the 7.17 shares bought back, but I won't worry about that right now. Let's go see analyst estimates. Jesus Christ, 18.31 per share to 30.4. That's incredible. Scroll down here, revenue growth, 22 billion up to $34 billion in revenue. Oh, am I going to regret not buying this thing sooner? This is one of my 33 stocks that I want to own forever. It's incredible. Now let's do the stock analyzer tool. History. Let's pull up Adobe and see what I've done in the past. All right, guys. I did 6, 10, and 14% for my low, middle, and high assumptions on revenue growth. And for those of you who are new watching this video, watching our channel, we do this as a way of using the revenue growth, profit margin, multiples, et cetera, to determine the right price to pay for the company. This is a 10-year analysis, but you can do up to 20 years. 6, 10, and 14% revenue growth. Profit margin, I did 26, 29, and 32. Guys, guess what? This could be low because with an 88% gross margin, every extra dollar they sell is going to put more money down to the bottom line. So this profit margin could go even higher than this. I'm just being conservative here. Free cash flow margin, 38, 40, and 42. Again, it's a little bit low maybe as it drives up. Now PE. Guys, this is the hard part. What PE do you want to assign to this company? I don't know. This is part of the point of investing that makes it an imprecise art. We don't know. What's it worth? Is it 15? I think that's too low. Is it 30? Maybe too high. I'm sitting here and starting at 18, 21, and 24. That's where I'm going to go. Same with free cash flow. And finally, my desired return, I'm putting the 9% market return. No margin of safety. I'm just going to keep it at 9%. This is what I'm going to pay for the company, and then I'll assign my margin of safety later. And it's important you assign a margin of safety because valuation is an imprecise art. We are human. We make mistakes, and the future is unknown. We have no idea what's going to happen in the future. Those analysts don't know. They're making an estimation. Hit the analyze button. Boom. Guys, actually, based on free cash flow, might be a buy right now. I got to take another look at this. I have my watch list at $400, but I might want to reevaluate. Fifth and final company, UiPath. It's actually down 6% today. Guys, my girlfriend, Kathy Wood, owns this company. So immediately I think to myself, avoid this. But let's give her a little bit of the benefit of the doubt because even a blind squirrel finds a nut every once in a while. And let's see here. Well, it's an $11 billion company that lost $90 million last year, lost $207,000 on average the last few years. It is cash flowing now, $300 million bucks. Negative $32 million over the last 5 years. Okay. 85% gross margin. Now, guys, I will say this. Price to sales ratio of 8.45. Now, compared to the other AI companies, it seems kind of low. But I imagine, my guess is, because Kathy Wood loves being diluted as an investor, my guess is there's a lot of dilution in this company. Actually, they've bought back. No, they haven't. Not much dilution. 15% dilution. Not terrible. I'm actually surprised by that. Usually she loves being diluted 3 or 4 times. Guys, this is a company that if you want to buy, you're buying it on the future. Of course, like all companies, I'd focus on the price to sales ratio. This company's all-time high was $90 back on May 28, 2021, and it was $12.38 just a year ago. Now it's $19.46. It's down a lot. That's no reason to believe a company is going to do better just because it's down a lot. But here for this company, let's see what analysts are saying. Analysts are expecting, okay, not bad. Profit growing pretty decent amounts over the next few years, almost doubling in the next 4 or 5 years. Revenue, almost doubling again. So, all right, not bad. I mean, this is a play of like, are you okay with losses? It seems like they're probably out of those losses potentially, but that's the way it is here. Now, guys, if you want to see the 33 companies I want to own in the future, watch our next video. And don't forget, click the link below to join our community to help make less emotional, costly decisions. Thank you for your time.